Afternoon, everyone, and welcome. My name's Jeff Gartley. I'm here to talk to you today about employee share schemes. We get quite a few inquiries about how they work and how they're taxed. So I've put together this little presentation to assist you when you get your rather large tax bill, because that tends to what happen with these employee share schemes, and they come as a surprise. So let me share my screen, and we can go from there. So. Let's just start from the slideshow in the beginning. So, as I said, Jeff Gartley, chartered accountant down here in Ormond in Melbourne, and we're going to talk to you very briefly about employee shares. What is an EES, or employee share scheme? So, what happens in this case, instead of paying you a bonus in cash, your employer gives you shares. Now, the ATO treats that as income, just like a salary. So instead of receiving a bonus where they take the tax out, they're going to tax you on the share price. So even if you don't sell the shares, you can be taxed, and it becomes quite a surprise for many taxpayers. Let's talk about Jim, and that'll give you an example and an aha moment as to how it all works. So Jim's problem is he's got, as an example, 60K of ESS income. He has a 28K tax bill. No shares are sold, but he has a big tax bill. Why didn't they just pay me the bonus? The answer comes, well, companies do this because it keeps you involved with the business. So have you ever heard of the golden handcuffs? It aligns you with performance, and it can reduce their cash outlay because they issue more shares. They don't have to pay you the big fat bonus. So it works well for them, but it creates a tax problem for you. Why shares, not cash? Less cash for the employer, retention, alignment, global plans. Typically, you'll see this with listed companies, some private companies, and also international companies. So, the timeline, and this is the key concept: the grant, the vest, and the sell. Tax happens at the vesting. Now, here's the most important point. You're not taxed when you sell the shares. You're taxed when the shares vest. That's the moment they truly become your shares. And that can happen 2, 3 years down from the grant date. And that's when you have to declare the discounted amount into your tax return. So let's say your shares vest at $600. So $600 is treated as income. So if you receive $60,000 worth, that's what gets taxed at the time. So here's what most part that people miss. That $600 becomes your cost base. So if you sell later at 800, assuming you get it upward, you only pay tax on the difference, which is the 200. Now you could also create a capital loss at that stage, and that upsets people as well. So if your company or your employer doesn't perform as well, and you buy them at 600 and you sell them at 500 because the market's dropped off, there's a capital loss. What does the tax office say about this? Well, it basically says, will you pay tax at the time of the value? But I didn't want the shares. Well, then you have to go back to your employer and say, give me the cash. Now, this is part of your salary package, so that's a separate issue to what the tax office says. But it says at the time that these were vested to you, that's your bonus, so you must declare the tax. The good news is the 600 becomes the cost base and is not taxed twice. The bad news is the share go down. Really, you've been taxed at a higher rate, but that's just the way the system works. So here's an example when you sell. You sell at 800, the 200 gain is taxed, and you receive a 50% discount if you hold them within 12 months. So you're not taxed twice, you pay tax on the 600, and you can only pay capital gains tax on the growth. But here's why it feels wrong. You didn't get the cash at the start. The tax comes later. maybe when you haven't even sold the shares, so you got to find the money for the tax, and it's not explained properly by your employer, so it feels like a surprise hit. And often we get that when we give you your tax return and we say, by the way, there's $60,000 worth of income that you've got to pay capital gains tax on. So you need to be aware of, sorry, normal tax, which is income tax, because the capital gain tax comes later. You just need to be aware that these things are happening. And when you get bits of paper that says we're now a lot of these and they'll be granted vested in 3 years' time, that's aware when you're going to hit the tax position. So what people are constantly doing is they're buying, they're vesting these shares that they're having to pay tax on, and they're selling to pay for the tax. So it's a bit of a planning exercise. So what to do next? Track the vesting. Not simple, but it needs to be done. Plan tax early. Sell some of the shares if you need. Get advice from tax accountants like myself or your planner. And offset super if you can use super to reduce some of these income tax bills. And of course, use capital losses moving forward to reduce your capital gain if you sell these shares. So it all comes back to doing a bit of planning and a bit of tracking, probably the day that these shares are granted to you. So, of course, very brief context of what we're talking about today. If you'd like some advice on that, contact us at 95979966. We have clients all around Australia, or visit our website for some more information.